Good morning and welcome to Organizational Types and Other Considerations for Small Business module of the Smart Money class from the Urban Chamber of Commerce for Las Vegas. I'd like to welcome everybody who's in attendance and hope you're having a wonderful day. So today we're going to go over different types of organizations that you can have your small business created under, and the different legalities that come with it, what the tax breaks are and whatnot. And we're going to go through various questions, and you can interact with us. So if you have questions or comments, you can put them in the chat, or you can be on camera and speak directly to me. It is an interactive class, so you're more than welcome to ask questions, and I will ask questions of you. So please feel free to join in the conversation, because that makes the class go a lot easier, and I can actually ask you answer directly what questions you have, and it'll help make your business run much smoother and easier as we go. So some ground rules: if you are on camera, please make sure that it is family friendly, and dogs are barking or anything like that, please mute yourself. No eating or anything like that. I will be drinking because my throat will lock up on me if I don't. So let's get started. Let's see what else we have here. In the chat there is a participants guide. If you'd like to follow along with us, the participants guide is in the chat, and I believe this is going to be on YouTube or some other media outlets that are going to be out there, and the guide should probably be attached in the notes area, wherever you'll be able to find it. So the objective of the class today is to identify, you can go to the next slide for me, please. Thank you. And let me introduce myself. My name is Alana Ariel. I am with an organization by the name of Add a Change. It is a local organization here in the Las Vegas area. I was asked to come in and present with the Urban Chamber of Commerce as a special guest instructor. My background is, I have a legal background, went to law school in Baton Rouge, Louisiana, Southern University. Go Jags. I also went to the University of Las Vegas for law. I went to law school in Baton Rouge, Louisiana, and I also went to law school here in Las Vegas, University of Las Vegas, Boyd School of Law, for my gaming law master's degree, master's in law. So I have a little bit of knowledge working with and consulting in the gaming law and businesses directly related to that whole industry there. Done some consulting in the legal field, compliance, regulations, rules, all the good taxes. I have a whole about 20 plus years of experience in all of that, a whole resume of whatnot. So that's neither here nor there. That we'll just go on and get you guys started and get this whole thing going here. So the objectives today and what we want to follow. We want to go ahead and go to the next slide for the objectives. So our objectives are to identify the general characteristics, advantages and disadvantages of each of these organizational types for the small businesses: your sole proprietorships, your partnerships, your general limited liability, C corporations, and S corporations. I'm sorry. Okay. Now, what do you know? So what do you know, or what do you want to learn about organizational types? So we do have, it was OC? Is that who that, did you have something specific? Aussie, I'm sorry. Yeah. Aussie, what specifically did you come to learn today?
Okay, I'm doing some work with some volunteer work with someone that owns a business, and I'm going to work with her and help her out. So general business information, she signed me up for the class so I can obtain just some general business information. However, I do ministry, so I want to see how that's related to this as well, or how I can go about setting that up.
Oh, wow, that's great. So when you say ministry, so are you looking like nonprofit?
Yes.
Okay,
Nonprofit.
so nonprofit isn't listed in here, but it actually is more of a dedication by the by the IRS tax code. So it does actually fall under a business category here, that we have a business type, and then it gets the designation from the IRS. So you would pick one of these business types that we're going to go over, and then you also get the designation from the IRS on top of that.
Okay.
Okay, so it'll apply both ways.
All
It's
right.
just extra step into the paperwork. Now, what type of business does your the person you're volunteering with right now, what kind of business is it?
Okay, now I'm just starting, so
Okay.
I'm not sure. It's fingerprinting. She'll be doing a lot of different things. I'm
Okay,
not
so
sure what type it is, though.
okay, so you're starting with fingerprinting.
Yeah.
Okay. All right, that's great. That's exactly what we want to know.
And lab services, fingerprinting lab services, urinalysis.
Oh wow, a great industry to get into. Okay, so let's see here. Now in the instructor's guide, or I'm sorry, not the instructor's guide, the guide that we have following along, there is a couple of questionnaires that are in there, and this will, if you go through them, and it helps you figure out exactly where you are, and it actually helps me figure out how much and how little I need to teach you. So it sounds like you are on the beginner's level. So I'm going to go a little bit more in depth on on some of the topics here, and we'll get you as much knowledge as we can possibly get you here in the time allotted. Okay, so if you have any questions, feel free to just go ahead and jump in and ask the question, since it's just going to be you and I right now. And if anybody else jumps in, then they show up a little late, that's not a problem. We'll go ahead and allow them to ask their questions as well. Okay.
Okay, thank you.
No problem. Okay, and we can go to the next slide. Okay, so we have our organizational types. Again, there are 5 common types of organizations, also called legal structures or legal entities. Whenever you're speaking of the legal entities and the legalities, when we get into them, we want to go ahead and list these 5 common ones that are here. There's sole proprietorship, your general partnership, your partnership, general, limited, and LLP, limited liability partnership. Then your limited liability company, which is your LLC, your C Corporation, and your S Corporation. So with your sole proprietorship, let's jump into those directly. Okay, we can go to the next slide. Okay, so you want to look at the factors when you're choosing each one of these. So we're going to break them down, each one. When you're looking at it, there's the 5 factors that you want to look at. You want to look at your taxes. What taxes are going to be involved with as a business owner? You should match the legal structure to your business considering these 5 factors. How much of the taxation you're looking at, your liability and risk, your management, your transferability or your ability to continue the business, how to persist, or if it's available to be sold. I don't know why I'm not being able to say that word today. Your expenses and your formalities. So with the taxation, the legal structure determines how you or your business is taxed for 4 of the common organizational type, sole proprietorship, LLC, and the S Corporation, the business as an entity does not pay taxes. Rather, the profits and losses from the business pass through the owners and are reflected on the owner's tax returns of the owners. So that means what's going to happen if you choose your first sole proprietorship, a partnership, LLC, or the S Corporation, you file your taxes for that business on your own personal tax return. Okay, so that's one of the things to consider when you're looking at your, I'm going to choose what type of business I want to make my, what organizational type I want my business to be. Okay, so most individuals, most people look at your organizational types and they jump in and they say, okay, so what are we looking at here? I'm going to get started and get a business started. Now, when we go to sole proprietorship, now that's usually the first one most people understand, or I should say don't understand. So the individual that you're working with right now, for instance, they can start their, well, the business that they've chosen, fingerprinting, is going to be a little bit more structured and have a lot more laws that they're going to have to comply with, rather, because it's fingerprinting. So, and lab work and whatnot. But let's take the ministry that you're speaking to. That type of an organization, for instance, you could stand out on a street corner and start a ministry. If people start gathering and you make it a regular thing every Sunday, you start, and you say you start meeting at the park every Sunday, and all of a sudden everyone starts to come, and you make it a regular thing. Now you want to make it into a business. You've already established a name for it. Basically, all you have to do is register the name and you're in business. That's called a sole proprietorship. You would be the only one who is in the business. That's why it's called sole, because you're the one person, solo. So yeah, so you'd be the sole person who's running the organization, and once you paid for the name, that is all the only legality that is required of it. So that's pretty much it, and you're in business. However, when we get to the taxation part and we go look at those other 5 factors, what comes into play is how will we get into those other 5 factors. We look at all of the different stuff that comes in. So when you have a solo business, it's just you, right? So no, you can't bring in somebody else and say, well, this is my partner. Well, because that doesn't make it sole anymore. So now you have a partnership, and that requires a little bit additional paperwork. So then we're going from sole proprietorship to partnership. Okay, so that's how we're going to go from sole proprietorship to partnership. So then we get into partnership, right? Partnership, pretty simple. We can go from one partner, I'm sorry, 2 people, that's a partnership. So 2 people up to 20, that's a general partnership. That would be very simple, and that's your simple partnership. Again, very little paperwork is required. You want a partnership agreement that comes into play, and what's going to happen there is, as long as you spell out what each partner has going on, if it's a 50-50 partnership, everything's going to be split. So it's 2 people, easy, 50-50. Any money that's contributed, we're going to split the profits 50-50. You contributed 50%, I contributed 50%, boom. Okay, now we bring in a third person, but let's say that third person isn't isn't quite bringing as much. They're only going to bring in 10%. Now we're looking at, oh, wait a second, that person's bringing in 10%. You brought in 40%. I brought in 40%. This third person brings in 10%. That person is going to be limited to our profits that we're bringing in. So we're only going to give them a limited partnership. So again, we create this partnership agreement, which puts us in business. That's pretty much the only requirement to organize this type of business. We have a partnership agreement. Most people don't understand that this gets you in business, all right? So what happens is you start working with your partners. So you and your best friend and 3 people all decide they're going to do this. One person brings 10%, one brings 40, the other one brings 40. All of a sudden, you're in this partnership. The person who brings in the 10% starts making deals with other people. So let's say you're doing your ministry, right? And you have 3 people who are going to do the ministry together. So you have the 3 people, they all show up, they're doing the work, and the person who brought in the 10% decides they want to rent a giant hall and say, this is where we're going to do our ministry every single week. Okay, so they rent the hall and they go and obligate the business for 10 years at $10,000 a month. The other 2 people automatically become liable for that $10,000 for the 10 years because they're in that partnership agreement. So limited partnership and limited partnership, they put the agreement together. Depending on what the partnership agreement says, they could say they were going to be everything equal. They could say they can go ahead. Llc, you have a question?
Okay.
Yes.
Yes. The person I'm working with that signed me up for the class is trying to get in, Alana.
Oh, okay.
Third person trying to get in.
Two people. Third person trying to get in also.
All right. Well, let's let them in so they can get this information too before I get too far along. There we go. Quite a few people on now. All right. Hey, good morning, everyone. If you'd like to be on camera, you're welcome to put your camera on and go over a quick group of rules. You're welcome to be on camera if you'd like, and you're welcome to jump in if you have questions or if you'd like to speak on a topic or share anything that you would like during the presentation. It is an interactive class, then this will help it go and be conducted in a much better fashion there. So let's see here. Can we go one slide back? Since we're still on that topic there. So we're speaking about partnerships right now. We're talking about general partnerships, limited partnerships, and limited liability partnerships. So once you write your partnership agreement, if you have, you can have anywhere from two partners in an agreement for a partnership, all the way to 20. When you have a partnership, you're going to require that you do a partnership agreement. What is required in those partnership agreements is you want to make sure that you're establishing what your what the individual will contribute, what they will get back out of goodness, I lost my train of thought there. Okay, so what they're gonna contribute to the business, what they're going to get back out of the business, and how they're going to be how they're going to fund the business. So, for instance, if OC is going to put in 40% of the business, then she's going to be able to refund 40% back every time they pull out any kind of funds to the business from the business making money. So, okay, there's a question and it's being popped up, so I'm not seeing the chat. So, okay, there it is. Okay, so that's not a question for me. Sorry about that. Okay. Let's see here. Okay, so then we're jumping to limited liability corporations. This one here is where you do need to file all of your paperwork with the State Department, and you make sure that you have your articles of incorporation. And a lot of people think that articles of incorporation are this really daunting thing, but really what they want to know is how long you're going to be running your business. Most of it is a perpetual thing. What you're actually doing with your business. So they want a breakdown of what your business will be doing, if it's going to be and you don't have to be very specific. It just has to be a general paragraph of what type of information. So you're going to be running a ministry. It's for the good of the community. It doesn't have to be very detailed. It just has to be a quick overview of what your business is going to be. Because what happens is a lot of times you get into, I have this great idea. I'm gonna do a ministry, and you want to, if you get really, really specific, you may limit yourself, or you may change your idea altogether. So you want to be a little bit vague when you put that together, so that you give yourself room to grow. Okay. While we have everybody on, does anybody else want to share what other types of businesses we have in here, so that I can speak specifically to those businesses? That'll help keep us interactive here. So, Bob, how about you? Lorania? Ms. Richard? Oh, she says she's unable to hear me. Okay, so I'm not sure what's going on.
Tell her I can.
Okay, let's go to. All right.
Okay. Alana, she can see you, but she can't hear you. So I'll put my phone up so that she can tell you what type of business she has. That's the one that signed me up for the class.
All right.
Can you hear me, Alana?
I sure can.
See, I can hear you through Ossie's telephone, but I cannot hear you from my computer. And I don't want to disrupt your class, so I'll just listen through her phone.
Okay. Can you tell us about your business?
Yes, I sure can. I own a couple of businesses, but the one I'd like to share today is Fingerprint Masters and Lab Services. We provide live scan fingerprinting services, and we also do lab services, which include urinalysis testing.
Okay, great. Wow. Okay. Very nice. All right. Okay. Does anybody else want to share what their business does or any information that they're looking to get out of the class before I go on? Okay. So we will go on to, we'll move on with the presentation then. And let's go ahead and move the slide forward then. Now, we were speaking about the factors for choosing an organizational type. Taxation, the taxes, oops, hang on a second. Let me match up my feed here. Okay, so the factors that you're going to consider are the taxation. 5 factors: the taxation, your liability and risk, your management, the continuity, and transferability, expenses. The legal structure determines how your business or your business is taxed. For 4 of the common organizational types: sole proprietorship, partnership, limited, the LLC, and the S Corp, the business as an entity does not pay the taxes. Again, rather, profits and losses from the business pass through to the owners and are reflected on the personal tax returns of the owner or owners. Taxes are reported on the actual owner's tax returns. Only C corporations as a business entity pay taxes. So the liability and risk is one of the second factors that we're looking at. The liability and the risk to which you are exposed when you start a business can generally be categorized as person or property and contractual. So the person or property category, also called tort risk in the law, is defined as intentional or unintentional harm to the person or property of another person. Some examples of tort risk are you're looking at worker injury, product liability, automobile liability, general liability, such as when somebody falls on a wet floor. Contractual liability and risk is associated with contract disputes, which with those whom you're doing business with. So the legal structure determines who or what entity is legally responsible for the liability for judgments if there is a successful lawsuit against the business. So when we refer to tort, it's like a civil action that's brought against you, or a lawsuit, basically any kind of claim. So I just want to, that they call them torts in the legal field. So I don't want to get into the legality, because you guys will be like, what are, it gets really confusing when you use the legal jargon. So in particular, judgments brought against a business. So if you ever get sued, if your business gets sued, they're looking at who's going to pay the person for the damages. In particular, the judgments, that's what the damages are going to be against a business, could result in the owner being held liable to pay the damages. All of the owner's personal assets, including your owner's home, could be seized to pay a judgment. So when we're looking at liability, we're looking at who's going to be obligated. So we're looking at personal assets, your home, your car, everything you've worked hard for your entire life. Those could be seized to pay a judgment. New business owners commonly misunderstand liability factors, and they assume they always need to incorporate to protect themselves from liability. Insurance and well-written contracts can help manage risks to new business owners. So just those are things that you want to look out for, and don't assume that you have to incorporate right away. We'll get into that in just a second. So management, your decision making and and who has the authority to do what in your management style. So each legal structure has its own decision-making authority. Transferability. So this factor refers to how a business will persist and how the business is sold to a new ownership. The last one is expense and formality. Expenses, complexity, and legal responsibility differ between the different types of business structure. So when we get into each type of business, we'll go, each type of organizational type, we'll go over each one of these factors for each one. Next slide. So which organizational factors have the most impact on your business? Anybody out there want to answer this question? If not, we will move on and we'll go over each one and then we'll come back to the question. Okay, so there we go. Thank you. So let's go with the sole proprietorship. So a sole proprietorship is the type of business entity that is owned and run by one individual, and in which there is no legal distinction between the owner and the business. In other words, the business is one and the same as the owner. The sole proprietorship is the most common form of legal structure for small businesses. The taxation on a sole proprietorship has a pass-through taxation. So that means it's going to go, the business itself does not file a tax return, rather the income or loss passes through and is reported on the owner's personal tax return. Sole proprietors often need to make a quarterly estimated tax payment. So if you are making an income and you're actually making money on the business, you want to make sure that you're paying ahead so that by the end of the year, you don't have a huge tax bill when you file your taxes. And all of a sudden you have to say, okay, well, now I got to write this giant check to the IRS on April 15th. So that's what they're speaking to. Now, liability and risk. The owner of a sole proprietorship has unlimited personal liability for any liabilities incurred by the business. You can manage much of the risk with insurance and sound contracts. So taking, let's see, so we have a ministry that we're talking about and the lab that we're talking about. With the lab, have you looked into any insurance or any with the fingerprinting? So this is kind of a harder one to do a sole proprietorship with. This type of business, you're going to really have to, there's a lot of state requirements and regulations. So I don't know that we would be able to do it with that. With the ministry, you definitely be able to do insurance and contracts to limit your liability there, and risk. That is definitely one that you could definitely have some sound contracts on in order to just limit the risk, and then any type of contracts that you're using with vendors, be able to limit your liability there as well. So management style, the control of a sole proprietorship belongs entirely to the owner, who also assumes the full risk of the business. Now, transferability. A sole proprietorship lasts as long as the owner is alive and operating the business, or until the business is sold. The owner can also sell business assets as well as transfer the business to a family member, usually through a state process. Okay. Expenses and formalities to get one of these up and running. The sole proprietorship is the simplest way of doing business. The costs to create a sole proprietorships are very low, and very little formality is required. A sole proprietorship may be an appropriate form of business for many small and startup business ventures. When you're looking at doing a sole proprietorship, this is recommended if you wanted to do a proof of concept. So you're not too sure if the business is going to work, but you want to get it up and running a little bit before you go and invest a major amount of money into it. You could start by doing a sole proprietorship and getting it somewhat running, and then you can see. So it's a one-person company, generally has three structures, three choices of structures: your sole proprietorship, a corporation, or an LLC. When two or more people operate a business for profit as co-owners, they have two general additional options in their structures. That's general partnership and limited partnership. Did you have a question, OC?
No, Lorania, do you have a question?
I do not. That's okay. Thank you.
Okay, I just want to make sure. Okay, so on to general partnership. A general partnership is an association between two or more people, as we said before, in business seeking a profit, of course. Like a sole proprietorship, the partnership has a pass-through taxation, and owners are personally liable for the debt of the business. General partnerships can be created with little formality, but because there's more than one person involved, the written contract stipulating the terms of the partnership, called the partnership agreement, should be created. I always want to stress that it really needs to be created up front. I've done so many partnerships and I feel so bad because I always stress, when you get into a partnership, make sure the first thing you do is you write out the partnership agreement. Because 9 out of 10 times what happens is they create the partnership, they start doing all the work, they get about 6 months to about a year in. Usually it's about 3 to 6 months in. And one of the partners decides they don't really want to be part of the business, or the other partner says they're not doing their share and I don't want to be partners with them, or they're not putting up enough money and they're not doing what they said they were going to do. They're not showing up when they're supposed to. And all of a sudden, they're no longer partners. But what happens is, and people do not understand this, any agreements made by one partner obligates the second partner. Okay, so you are automatically obligated for any agreements, any contracts. If you go open a cell phone plan for the business, you're advocating for the business. You're saying ABC Ministries is going to open 10 lines of phones, and we are going to pay those every single month, and we're going to give out phones to 10 of the employees, and they hand out all those phones to all the employees, and then that's the partner who leaves. Well, the partner who is still there and showing up and doing the work gets to pay that bill. So that's how a partnership works, whether it's with 2 partners or 20. So you really want to make sure that when you start a partnership, you create the partnership agreement right away. and you specify as much as absolutely possible. If you get into, well, we'll get into the liability in just a second. So taxation on a partnership, like a sole proprietorship, a partnership is a tax reporting entity, not a tax paying entity. So again, it's a pass through. The partnership must file an annual information return with the IRS, the U.S. Internal Revenue Service, to report the income and losses from the operation, but it does not pay federal income taxes. The partnership it passes through any of the profits and losses to its partners, which are divided based on the partnership's agreement. Each partner includes his or her own share of the partnership's income or losses on his or her tax return, and may need to be estimated for their quarterly tax payments. Again, you want to double check and make sure that if you're having great sales, that you pay those taxes in quarterly increments. So every 3 months, you're sending a check off to the IRS with the EIN number saying, hey, we're getting ahead of paying our taxes, rather than waiting for the deadline and then ending up with this giant tax bill, because they will put the interest on it and then it gets even bigger very fast. Let's see, check with your state and government for fees and taxes that the state may charge for partnerships as well. Now, risk and liability. Owners of general partnerships have unlimited personal liability. Again, this is just like the sole proprietorship. In general, each partner is jointly liable for the partnership's obligation. Joint liability means that each partner can individually be held responsible for the entire amount of an obligation of the partnership. So, so that's that. One creates the problem, the other one has to pay the problem, pay for that bill. However, as with sole proprietorships, insurance and quality contracts designed can protect the partnerships against most of the risk. So there are ways to contract and put those in place. Seek a very good lawyer who knows what they're doing in contract law for that. Let's see, management. Partners have equal management rights unless otherwise stipulated in the partnership agreement. That's where you get into limited partnerships. So with that partnership agreement, you can limit what the partner can do management-wise. You can limit management-wise. You can limit what funds they can pool, or what funds they can pool, what funds they contribute. You can limit what they obligate you to. So that's why contracting and a good attorney writing up your agreement are key factors to a partnership agreement. And making sure that you have a quality partner. It's much like a marriage. You really, really want to make sure that you know the person you're getting into a business with. Okay, so being able to continue the business and transferability. A partnership exists as long as specified in the partnership agreement. The partnership agreement will determine the consequences of partnership of the partner if one of the partners dies or leaves the business. The business could remain in the hands of the remaining partner or be dissolved. You don't usually see them being passed on to family members. That's kind of rare. Or being sold off. It's a little too complicated when it's partnerships like that. Expenses and formalities. Again, general partnerships are similar to sole proprietorships in their legal creation and maintenance, and thus have low expenses and legal formalities. New potential partners could or should create their partnership agreement with the help of an experienced attorney and accountant. Definitely get an accountant to make sure that all of the expenses and deductions will be accurate on both ends. Partnership agreements cover topics such as capital contributions, distributions of profits, management duties, bookkeeping, banks, terminations, credit. See, they don't mention everything in here, so definitely want to mention credit in your partnership agreement. Okay, next slide for limited partnerships and limited liability partnerships. One more, please. Oh, actually, wait, no, that's right. You're right. I'm sorry. Okay, so limited partnerships. Your limited partnership and your limited liability partnerships are two other organizational options for two or more people who plan to maintain a business for profit. Some jurisdictions only allow those who are licensed to practice with certain professions, such as law or accounting, to be eligible for the LLP structure. That's the limited liability partnership. And the tax treatment for limited liability partnership and limited partnership is similar to the general partnership as discussed earlier. Profits and losses are passed through to the partners, so the partners can reflect them on their own individual tax returns. Same as the other two. Now, when we speak to liability and risk, with the limited partnership structure, liability varies depending on the type of partner. So a general partner has unlimited personal liability. Again, that's unlimited personal liability. A general partner is responsible for the everyday operation of the business. A limited partner are personally liable only up to their personal investment in the business, in the partnership. So the limited partner must maintain a limited role in the day-to-day administration of the business. Legal counsel can advise what, if any, activities are permissible for the limited partner besides contributing capital, so to perform without losing the shield of the limited liability. One of the reasons they do this is, for instance, if you're owning a restaurant and you want to become an investor in the restaurant, you might not know how to cook at all. So you're going to limit what that partner can do. I can contribute money. That's all I can do. So that means I'm not managing the day-to-day tasks. I'm not ordering food. I'm not doing anything other than just contributing money. So I can receive the fruits of your labor, but I can't get in there and do the labor. So that's one of the ways to limit your liability and risks. And it also prevents anybody from suing you because of, you were served something and got food poisoning because you had nothing to do with that. So with a limited liability partnership, personal liability for the partners may be limited, but the rules again vary from state to state. So you do want to make sure that you're looking at which state, which information that you're considering opening your business in. So let's see, management. The general partnership is the general partner is a limited partnership is responsible for the ordinary operation of the business. So the limited partner does not control how the business will be run. The limited partnership structure generally encourages investors for short-term projects or for investing in capital assets. It is not often used for operating retail or business services. So, so continuing it and transferability, how long does the limited partnership exist depends on the partnership agreement. Again, you want to make sure you have the partnership agreement in place. Generally with the limited partner and limited liability partnership, these go, that is the exact first thing that gets done with this. This is really more of a, well, they're both business transactions, but this is like a serious business transaction where you have people coming in with just investment dollars and really want to make their money on this, on these deals. So the partnership may also be terminated if a partner becomes disassociated with the partnership, such as if a partner wants to leave the partnership. That usually, if the partner, if a partnership, if one of the partners leaves, that automatically dissolves that partnership. So that ends it right away. Your expenses, again, unlike a general partnership, the creation of a limited liability partnership and limited liability partnership requires the filing. So this is required filing, possibly including I'm sorry, not possibly. You do want to file the actual partnership agreement with the state. A limited partnership will likely also be required to include the limited partnership or the LP as part of the name. So if you're doing the ministry, then you want to put the LP at the end of it, ABC LP, ABC Ministries LP, so that it shows that you're just a partnership, limited partnership. Just as limited liability partnerships will require to include the phrase LLP. So if you see an attorney law firm or anything and it says LLP, that means that the two partners in that law firm are a limited liability partnership. So, okay, now we're on to the LLC. This is the one that everybody is always speaking about, and most attorneys tell you this is the one you want to get involved with and recommend that you do. Not everybody needs an LLC, but you know, this is the one they recommend. So let's jump into it and see what all the goodness is about here. So an LLC is similar to a corporation in some ways, while similar to a general partnership or sole proprietorship in others. An LLC is considered a type of unincorporated association, not a corporation, even though it is a business entity. So similar to a corporation, though owners have limited personal liability for the debts and actions of the LLC, so you get limited liability. Other features of the LLC are more like partnerships, including the benefits of pass-through taxation and great management flexibility in allocating profits. So owners of an LLC are called members. Since most states do not restrict ownership, members may include individuals, corporations, other LLCs, and foreign entities. So an LLC can have any number of members. Most states permit an LLC with only one owner to be called a single member LLC. To form an LLC, you file the document. You file documentation called the Articles of Incorporation, which we were speaking about earlier, with state agencies, often the Secretary of State, under a filing. You pay a filing fee and create a LLC Operating Agreement, which sets out the rights and responsibilities of the LLC members. Again, these documents don't have to be so long and drawn out. Most people think that they want this whole dissertation. The state does not want that. They prefer maybe 2 or 3 pages, just basically stating all of the generalities that your business is going to be working with, and it just wants a good overview of what's going to go on in your business. It doesn't need to have every single minute detail. So taxation, like a sole proprietorship or a partnership, an LLC is not considered separate from the owner for tax purposes. Instead, an LLC is what the IRS calls a pass-through entity. The business income passes through the business to the LLC member. So the business owner of the LLC gets to put that information on their own personal taxes. They get to report their shares of profits or losses on their individual income tax returns. Each LLC member may be required to make quarterly estimated tax payments. Again, get ahead of the taxes rather than behind. And the LLC business files only an informal, the LLC business files an informational tax return. So traditionally, a trade-off has existed between liability and taxation. However, the S Corporation and LLCs have changed this dynamic to the point where a business owner can now have limited liability and pass-through taxation. Liability and risk. Like owners of a corporation, all LLC owners are protected from personal liability for business debts and claims. Claims are lawsuits or tort actions, like we stated before, a feature known as limited liability. If a business with limited liability owes money or faces a lawsuit, only the assets of the business itself are at risk. Creators usually cannot reach the personal assets. Creditors cannot reach the personal assets of the business owner when it's an LLC. So you're looking at now that's I got to say that with the exception of cases of fraud and when there's illegal activity going on, there's always exceptions. So there's always exceptions. Okay, so owners of an LLC must take care not to pierce the corporate veil, which would expose the owner to personal liability. So when we speak of the corporate veil, for example, the LLC owner should not use personal checking account for business purposes and should always use the LLC business name rather than the owner's individual names when working with customers. So I want to make sure everybody understands what the corporate veil is. When you own an LLC, when you own an LLC, you're basically become a corporation. It's kind of like the easiest way to explain it and give you an understanding is kind of like you just had a child. So now your business, ABC Ministries in this case here, is now its own standalone individual. So you have your own individual self, and then ABC Ministries. So that's two people now. Okay, so you're two separate entities. Okay, so what you want to make sure is when you say piercing the corporate veil, you don't want to take the money from the ministry and use it for your own personal stuff. So you don't want to go and pay your own personal electric bill at your own house with all of the money from the ministry, or you don't want to take your house money, your own personal for your own personal debts and whatnot, and pay the ministry. So you're not going to take your personal checks and write those and take them over there and say, oh, okay, well, I'm just going to use this. And so once they start seeing that and the lines start getting too blurry, then that's the corporate veil. So it doesn't really exist. There's nothing there. But when they say piercing that means that you've crossed the line way too many times and we don't know. You basically set this up for nothing because we can't tell the difference between the ministry and yourself. And if we can't tell the difference between the two, and now it doesn't matter whether it's a ministry or the fingerprinting company, a car wash, it doesn't matter what kind of business it is. Once we can't see the lines, then we know that it's no longer a business. So that's what they're talking about, and that's when you lose that you lose the feature of the limited liability. So then they can go back after you for unlimited liability. And if there's any kind of lawsuits or anything like that. Again, insurance and contracts can also prevent that stuff. So keep those in mind. Whether you're a limited liability corporation or a sole proprietor. Any type of business, you want to make sure you have those things in place either way. So, management. The operating agreement for an LLC sets forth how the business is managed. The owner of the most small LLC participants participate equally in the management of the business. So if you have two people, they both need to be participating in the management. This arrangement is called the member management. Alternatively, members can designate one or more owners or even an outsider to take responsibility for the managing of the LLC. So non-managing owners, such as family members who have invested in the company, share in the LLC profits or losses without participating in direct management. Again, that's all spelled out in the organization paperwork. So to transfer, the transferability, this is one of the benefits of the LLC and one of the reasons why let's see here. So the LLC members, somewhat like partners in the partnership, cannot transfer their ownership. In most circumstances, an LLC does not, because hold on a second. I lost where I was at. Okay, so these are, let's see, in most circumstances, the transferability of the LLC is dissolved upon the death of the death or the retirement of the member. In some states require the LLC operating agreement to set the limits of the company's existence to 30 years. Also, states may require majority or even unanimous members' consent to transfer ownership to a new member. So, expenses and formalities. One disadvantage of forming an LLC instead of a partnership or sole proprietorship is that you pay a filing fee ranging anywhere from $100 to $800 when you submit your articles of organization. So on the opposite side, where articles of organizations are short, simple documents, you may be able to quickly prepare articles of organization on your own using forms provided on your state's filing office. Usually if you go to your state's corporation commission, that's where you'll find these types of documents in the self-help section. Again, that's the state's corporation commission website. Even though let's see, even though an operating agreement may not be required by your state, you should create one anyways. An LLC operating agreement sets out the rules for the ownership and operation of the business, much like a partnership agreement or corporate bylaws. The typical operating agreement includes the percent interest in the business of each member, and the member rights and responsibilities, your member voting powers, your profits and loss allocations, management structures, rules for meetings and voting, Also includes, you want to also include the operating agreements, are buy-sell provisions, which determines what happens if a member wants to sell their interest in the company, or when a member dies or becomes disabled. So you want to note all of that in the LLC operating agreement. Next slide, please. Okay, corporations, C Corp and S Corp. So a corporation is the legal entity that is separate and independent from people who own or run the corporation. The legal entity created under it is created under the laws of each state. So this means that the corporation itself, not the shareholders, own it. It is held legally liable for the actions and debts incurred by the business. As a corporation, it has privileges such as the ability to enter into contracts, but it also has certain responsibilities such as the payment of taxes. Corporations are more complex than other business structures. There are potentially costly administrative fees to create and maintain corporations, as well as more complex tax and legal requirements. Most businesses do not need to incorporate. That's the big thing down there, is most businesses do not need to incorporate. So corporations are generally suggested for established larger companies with multiple employees, or when certain other factors apply, such as corporations that sell a product or provide a service that could expose the business to sizable liability. Forming a C Corp or an S Corp is similar. For both, you file articles of incorporation with your Secretary of State, or with some states, your state's corporation division. Corporation Commission, same thing. Filing articles of incorporation will usually cost no more than a few $100s in fees, while the contents of your articles of incorporation may vary from state to state. Most will establish the following: your company name, your company purpose, company stock quantity and price, resident agent name and address. When they say resident agent, there has to be someone in the state willing to receive documentation for you if you are ever sued. So you can get a registered agent in any state for hire. They're usually like $35 a year if you don't know anybody in a state. You look to different states for different protections. So it gets into a little bit more detail if you're looking to protect yourself for various reasons. The state of Nevada is actually one of the better states to file a corporation or business in. It protects a lot of information from being publicly out there. So your corporation officers' names and addresses. That all has to be on file with the state. Only after the articles of incorporation are filed and accepted by your state does the corporation acquire legal existence. So once incorporated, the board of directors meets for the first time, followed by at least one annual meeting per year. The board of directors appoints officers who conduct the business of the corporation. Corporate ownership is more complex because a corporation has a legal identity separate from those of the owners. So corporations, both C and S corporations, designate ownership by issuing shares of stock. Thus, owners are shareholders who receive or purchase stock in the corporation. Shareholders typically have various rights, including the right to do the following: elect directors, receive information inspect corporate records, vote on fundamental business decisions such as mergers and liquidations, share in dividends, dividend distributions. Now, taxation for these corporations. For federal income tax purposes, the C corporation is organized as separate tax-paying entity. So a C corporation pays corporate income tax on any corporate profits. The individual who owns the corporation will pay personal income tax on the corporate profits distributed by the corporation to the owner. This creates the issue of double taxation. This is where you really need a good accountant. That is not my forte. So by contrast, your S corporation are corporations that elect to pass corporate income losses, deductions, and credits through to their shareholders for federal tax purposes. The shareholders of S corporations report their corporate income and losses on their personal tax returns and are assessed taxes at their individual income tax rates. This allows the S corporations to avoid double taxations on the corporate income tax. Now on your liability and risk. So a corporation is strictly defined a legal entity that is immortal. That is, a corporation does not terminate upon the owner's death. The corporation can enter into and dissolve contracts, incur debt, sue or be sued, own property, and sell property, as any individual may do. Corporations own them. Corporations Corporation owners themselves have limited liability. So if you're the owner of the corporation, you're going to have limited liability on yourself, but the actual corporation itself, again, this is its own entire entity by itself now. It even has voting rights. Oh, that was fun. With the limited liability, okay, I'm sorry. While the individual may own all the shares in the corporation, the owner is not personally responsible for the corporation. So you can be 100% shareholder. Everything is yours on paper, but you do not have personal liability for that company. So they can't attack your personal assets if you're ever sued for that corporation. With the limited liability, investors cannot lose more money than the amount they have invested in the corporation. Owners are not personally responsible for the debt and obligations of the corporation in the event they are not fulfilled. In other words, if a company with limited liability is sued, then the plaintiffs are suing the company, not the owner or investor. Okay, let me say that again. So, owners are not personally responsible for the debt and obligations of the corporations in the event that these are not fulfilled. In other words, if a company with limited liability is sued, then the plaintiffs are suing the company, not owners or investors. Like the LLC, care should be taken not to pierce the corporate veil. Personal checking accounts should not be used for business purposes, and the corporate name should always be used when interacting with customers. So, just like I stated for the corporations there, LLCs have that same liability factor. They didn't mention it before, but it is the same. That's why it's mentioned here. Management. A corporation's overall management is vested in the board of directors chosen by the shareholders. The officers handle the business day-to-day affairs under the board's general direction. In smaller corporations, the manager, owners, the board of directors are often the same people. So in the larger ones, those three roles can be held by different people. For example, corporate boards often place day-to-day management decisions in the hands of chief executive officers, CEOs, who may also be the board's chairman or president, the CEO's supervises executives, including the following people: vice presidents, who oversees various corporate functions, chief financial officers, your chief operating officers, chief information officers. They're coming up with new CCCOs all the time. So media, you name it, is coming out. So just as you wish, when you put it on the board and you give them their title. So be creative. Let's see. So to continue the business and the transferability, the independent life of the corporation makes it possible for its continuation, and the relatively distributed continued operation of the business, regardless of the capacity or death of one or more stockholders. So the corporation as a separate legal entity does not cease to exist if one or more of its owners dies. A business's corporate existence lasts as long as the shareholders decides the corporation should exist. So the corporation can last for decades through multiple generations of ownerships. Ownership of the corporation can be transferred by sale of stocks. Additional owners can be added either by corporation selling stocks or by current owners selling their own stock. Now, expenses and the expense and to form it. Corporations are more complex entities to create. They have more legal and accounting requirements and are more complex to operate than sole proprietorships, partnerships, or LLCs. Investors are more easily attracted to corporations, but more complex ownership, reporting, and management requirements go along with these advantages. Disadvantages also include having to hold regular meetings of directors, including keeping records of the corporate activities and maintaining the corporation's ongoing financial independence. So, next slide. Break down the difference between the C Corp. So the C Corporation, also known as the regular corporation, is the most common form of business entity for larger corporations. Remember, C Corporation, as a distinct legal entity from their owner, have several distinguishing characteristics, including limited liability, easy transferability of shares, this is the ownership again, and perpetual existence, meaning it can exist for as long as the directors want to keep it going. They also have centralized management structures that may differ, that may be different people than the owners. So the taxation with the C Corporation, the company itself is taxed on its business profits. The owner pays individual taxes on money they receive from the corporation as salary, a bonus, or a dividend. Double taxation is an issue with the C Corporation since the profits taxed as this corporation, as the corporate. Okay, so the double taxation is an issue with the C Corporation since the profits taxed at the corporate level are taxed a second time at the personal level as dividends. So you're going to get taxed once when you get the profits from the corporation, and then you'll get taxed again as dividends from the, so you'll get dividends because the corporation made money, and then you get taxed because the corporation made money. So that's fun to pay double taxes. So again, have a really good accountant if you are doing this type of corporation. The liability and risk, the S Corp and the C Corp are often the same limited liability. So management and ownership structures are the same for both the S Corporation and the C Corporation. Being able to continue them and transfer them, the transferability. C Corporations, owners are shareholders. So again, the corporation exists as long as the shareholders decide the company should exist. Ownership is transferred by the sale of stock. Let's see. The solution, I don't want to get into that right there. Expenses and formalities. The ownership of a C corporation, the owners of the S Corporation and the C Corporation must follow similar requirements. In addition, the C Corporation files its own tax returns. Okay, to the S Corp. Everyone is really quiet out there. Is there any questions, or these ones here are kind of, no, we're on the S Corp, I'm sorry. I didn't ask about the C Corp, but it's fine. They're really similar, so it's kind of quick when we're going through these ones. Okay, so a lot of the information is, again, it's really similar, so I feel like I'm repeating myself, but I just want to make sure that we get the same information out, and that it's what we need to hear. The S Corporation is the regular corporation that is elected S Corporation tax status. Forming an S Corporation lets you enjoy the limited liability of the corporation shareholder, but you pay your taxes as if you were a sole proprietor or a partnership. So you get that benefit of paying through the pass-through and not double taxed. So an S Corporation is formed by making a sub-chapter election when you form the C Corporation. To create a sub-chapter, you must first create a regular corporation with your Secretary of State or your state's corporation division. Then to be treated like an S Corp, all shareholders must file and sign an IRS form 255. I'm sorry, 2553. So that's the IRS form 2553. Earlier in the presentation, OC, I was talking about the nonprofit designation, the 501c3 designation. If you wanted to be a nonprofit organization, that gets you that nonprofit designation. That's the designation you're looking for, again, from the IRS. So the S Corporation, you have to file this additional paperwork to get that designation for the S Corporation. Similar to the nonprofit, there's a little additional there's additional paperwork that needs to go with that for the nonprofit. We don't cover it in this. Not sure why it's not included, but it's not. So sorry. I can get you some additional information if you'd like to follow up with me at a later time. Let's see. So the taxation on the S Corp, this is a major difference between the S Corp and the C Corporation. In an S Corporation, all business profits pass through to the owners, who report them on their own personal tax returns. As with sole proprietorships, partnerships and LLCs, the S Corporation itself does not pay any income tax although the S Corporation with more than one owner must file an informational tax return, like a partnership or an LLC, to report each shareholder's portion of the corporate tax. So they still want to see a report that says what the company did, but it's kind of like they want to make sure that everything adds up when all of the partners file their records. So you still got to file the informational report, and then each member has to file their taxes on their own reports as well. So your liability and risk, your S corporations and your C corporations have similar limited liability. Again, you're limited with that risk, so you're not going to have somebody come and attack all of your own personal assets. Awesome. Management and owner structures are similar. Again, you're looking at a board of directors for the management style on the S corporation. To continue in transferability on it, the S corporation and the C corporation owners are shareholders. So corporations exist for as long as the shareholders decide the company should exist. Ownership is transferable by the sale of stocks. Easy on that one. And then the owner of the S corporation, to form it, the ownership, the owners of the S Corp and the C Corp have the similar requirements, such as having the board. Again, the only real addition to it is filing that IRS form 2553. So next slide. So when you're choosing your organization, how do you decide which structure is best for your business? So when you want to go ahead and decide, well, which one of these is best for my business? Again, well, writing a business plan is usually your first step in determining what your business organizational structure should be. Your business plan is going to describe your key factors impacting your business, such as the market, your sales volumes, management structures, locations, marketing strategies, financing. That should tell you if you're going to have a partner, if you're not going to have a partner. It should tell you what kind of operations you're going to be looking at. Your business plan is going to give you a breakdown. So many people want to jump into a business and not have any kind of plan. You really want to be able to sit down and write a business plan up so that it gives you a direction to go in and something to follow. Okay, so your initial guidelines, your owner operating, your partnerships, your multiple owners, you're looking at all of these things. If you're jumping into a business and you've never run one before, you definitely want to sit down with someone. There is multiple organizations here and across the Vegas Valley that will provide you with at least the basic information that can help you and assist you with all of this information. It is overwhelming to be a business owner, so make sure that whatever business you choose, you're extremely passionate about the business itself. And understand that being a small business owner or even a large business owner, you're going to have to deal with all of this stuff that we're speaking about today, and over the last few weeks if you've been attending these classes on a regular basis. In addition to some of the questions to answer before deciding on a structure, you'll want to know who will own the business. Number one, is this a business that you're going to carry on and pass through? Do you want this to be a business that you're going to send a legacy with? Is this something that's going to go on for the rest of eternity? Is this a proof of concept business where we're not even sure it's going to work, but maybe and some of these things that are proof of concept businesses like Airbnb or When they started, it was, we don't know. It might work, it might not. The delivery business, the food delivery business, DoorDash and Uber, all of those were proof of concepts. They didn't know if it was going to work. Well, let's try it. Before they go to a big corporation, you start small and go from there. Who else is going to be involved with the business? Is this a partnership? Who will manage the business? Does your product or service carry a significant liability risk? Am I going to be sued for anything? People don't look at the long-term stuff on their businesses. You want to ask as many questions as possible when you're getting into a business. If it's anything, as much information as you can pull forward, you're going to be better off when you're starting these businesses. The better foundation you have, the longer your business can last. How much financing does your business require? Will you have an outside vendor? What is the sales growth potential? So for many business operator, for many owner operators of small businesses, the sole proprietorship is the right organizational choice, especially if it's a proof of concept and you've never had anything work, you've never seen anything like this before. Start with the sole proprietorship. Don't go jumping into all of the fees of an LLC if you don't even know if this is going to work at all. A partnership might be the right choice for a business with multiple owners. If you're going to start something with your best friend, again, make sure you're starting with that partnership agreement. Make sure you get everything in writing. I've seen people who, we're both in the same business, we should just buddy up and do this together, we can hit so many more. It rarely works out when it's like this. So make sure you get everything in writing so that there's not a separation agreement that has to be drawn up. I've had to write a few of those out. Those aren't fun either. Owners of businesses that sell products or provide the services with significant liability risks, make sure that you get the insurance that you need. Make sure you're contracting correctly. Make sure that your vendors are going to back up and give you liability. Make sure if you have a vendor that's providing you something that has a high risk, that they're taking on some of the risk as well. A C corporation or an S corporation, let's see here. Owners of small businesses that, let's see. A corporation should probably be the best choice for a larger venture with multiple owners and complex financing. Get advice from an experienced business attorney. You also find there's a wealth of information on the IRS website, the Small Business Administration, Women's Business Center, the Urban Chamber of Commerce, SCORE. There's the UNLV Business Center. There's so many organizations out here in Las Vegas that have opportunities for you to get the information you need. So I want to make sure that everybody has what they need. Right now, anybody on here, is there any questions or anything else that I need to make sure before I get into the 5 key points to remember? I want to make sure I answer everything. Okay, then, whoops, go back. Go back. Right there. Okay, so the 5 key points to remember: the organizational types you choose for your business impacts how you own your business. How you and your business pay taxes, how you get paid, and other important factors. Common organizational types: sole proprietorship, general partnership, limited partnerships and limited liability partnerships, limited liability company, your C corporation, and your S corporation. Okay, the organizational type can have the huge effect on lawsuits, on your assets, your own personal assets. So make sure that you understand what type of business and organizational type you need for your business. Every one of them is different, so make sure that you're selecting the right one for your business. As a business owner, you match a legal structure to your business considering the 5 factors. Your taxation, that's the biggest one. The reason it's the biggest one is because you're trading your basically your dollars for your time and your money for taxes. Everybody's going to have to pay taxes, so make sure that you understand where and how much taxes you're going to have to pay for each one of these business structures that you're choosing. The liability and the risk should be a huge one. Your management style and type, who's running this business and how's it going to be managed? Do you want this to be a legacy and go on forever and perpetually, or is this just your business and when you're done, you're done? Okay. The expenses, is this something that you can afford to do right now, or do you need to wait a little while and then grow it and make it a bigger corporation? There's nothing wrong with doing that either. So you can change into and grow into a bigger outfit. That's not a problem as well. So a sole proprietorship is the type of business where the business is one and the same as the owner. The sole proprietorship is the most common form of organizational type of small business. Again, remember you can manage the liability on that one with insurance. With that one, I want to mention like insurance. If you're doing something like Uber and you're using a sole proprietorship, make sure that you increase your vehicle insurance. See if there's any additional coverage or anything else that you can get on that. That your insurance agents, usually it's an additional $10 or $15 that you can do, or even pay $200 a month, may cover you for a much larger amount. That'll save you a ton rather than going and doing a whole separate entity and paperwork that's not necessary. So always ask and contract as much as you can if you're going to go sole proprietorship. Oh, I'm losing my voice here. The partnership is an association between the two or more. Again, they limit those to, I think, 20 people in partnerships, is what I have an understanding of. More people in the business, like the sole proprietorship, the partnership has the pass-through taxation. With the general partnership, owners are personally liable for the debts of the business, personal liability for the debts of the business. General partnerships can be created with little formalities. Again, in a partnership, if one of the partners gets into a car accident and it was for the business, the other partner is still liable, okay? Doesn't matter that it was just the one partner. Both parties are going to be liable in that type of situation. So have that understanding when you're going into a partnership, that you're going to be liable for whatever that partner does, and that partner is still liable even if they take off and even if they take off and you say, well, I'm no longer a partner in that business. That doesn't necessarily get them out of it. Kind of hard to collect on them, but they're still liable. You're gonna have to do a little bit more hunting on them to find out how to get a hold of them and collect from them. But usually the most responsible person will be the one holding the bag. So keep that in mind if you're doing a partnership, because more than one person is involved. A written contract listing the terms of the partnership, called the partnership agreement, should be prepared. Please, 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 please do that at the beginning of any partnership. Writing your business plan is the first step in determining your organizational structure. Business plans should be describing, and we mentioned this just a little bit ago, the market, sales volume, management structures, locations, marketing strategies, financing. Seems so boring what we're mentioning here. I get a really boring, dry topic because it's all legalities and compliance issues. There's so much more fun stuff and creativity in a business, but this stuff has to be done and taken care of because these are the technicalities that can trip you up and prevent you from being in business. So it's necessary. So in summary, we've covered a lot of information. What final questions does anybody have? Would you like to share anything that you've learned from the training? Did you learn anything? Did I just stay here and talk for an hour and a half, 2 hours almost, and lose my voice? Form in the chat, please provide the feedback.
Alana, this is Brenda. Can you hear me?
Yes, I can.
One of the things that I wanted to add to your presentation is that now the state of Nevada has training videos on YouTube. So when people go in to do their licensing, they can go to those videos and they're up to date. And they just started trickling through like within the last month or so.
Oh, awesome. Brenda, can you please tell everybody what your position is with UNLV?
I am a business development advisor. Basically, I'm a business coach. What we do are all these people that Alana talked about that can help you out. We're one of those people. And all of those people work together so that we can help you have the kind of business that you want to have and stay in business for as long as you want.
So Las Vegas has a wonderful, excuse me, Las Vegas has a wonderful community of business organizations that will help and assist get your business up and running. And we are so lucky to have that because there are so many other states that don't have the information available to us. There are so many schools and they want to help you get your business up and running properly so that you're successful. We want our businesses, our small businesses and our large businesses to be successful. So reach out if you need that information. That is great information that you provided, Brenda. Thank you so much for letting us know. Sometimes those videos are enough and sometimes you need more assistance. That's what Brenda's around for, myself. The Urban Chamber put this presentation together for us. There's so many other organizations I could mention. So if there are any other questions or anybody else needs any other additional information, please, the slides are available. If you notice on the bottom of them there, the Small Business Administration, the Women's Business Center, Urban Chamber of Commerce, SMART. This is what the Smart Money program. It's available through several different locations. You can just type in Smart Money for small business, and you can get a copy of all of the slides as well. If you have any other further questions or additional would like any additional information, you can reach me at Ariel at atachange.org. That is ARIEL at atachange.org. And if there's nothing else or any other questions, everybody have a wonderful day and thank you for attending today.
Thank you, Alana. I did learn some things.
Oh, thank you.
Yeah.